Friends, good evening. The final session for paper discussion CA Final FR is now we are doing. We have May 22 exam paper to be discussed. So already two papers are discussed. We discussed July 21 exam paper and we discussed your December 21 exam paper. So we had a session 6:15 to 7:30. Again we had a session 8 to 9:15 and this is the third session 9:45 to 11 p.m. The three paper discussions, past three papers are getting covered. And I tell you, this paper discussions are really helpful. Two reasons. One, you understand how the paper comes. You understand the type of questions which are being asked. And when you see that the questions which are being asked, we are already covered in class. That's directly from your material only, you feel confident. And number two, the way you need to write down the answer. Yeah, that also you're able to understand when we see these papers. So please make sure you are seeing this paper discussion. If any of your friends who have not attended the paper discussion, recommend them to watch these videos. These are extremely helpful. And tomorrow I'm having a MTP discussion. November 22 exam, there are two MTP, series 1 and series 2. So tomorrow I'm having a MTP discussion in evening for FR. Sunday I have a MTP discussion for auditing and Monday I have a paper discussion for auditing. So imagine we have paper discussion, MTP discussion in this week. Today paper discussion FR, tomorrow MTP discussion FR, day after is MTP discussion audit and Monday is paper discussion of audit. Now, I'm just taking you to the new batch which we have launched. At Unacademy, we have came out with a subject-wise subscription now. Yes, you don't have to take a full group now. You can take up a subject which you like. So FR is already launched. Audit, it will take 2-3 months of mine to get launched the subject wise. If anybody is writing exam in May 23 and they want auditing subject of mine, I'm recommending you to take up a G1 subscription. Yeah, 3 months G1 subscription you can take it. You can finish up the auditing over there. So if you want to attend audit, G1 subscription. If you want to attend FR, the latest FR ka batch is already launched and we uploaded kind of 35 lectures in that. Daily new lectures are being uploaded. These are high quality studio recordings and we will have a dedicated live doubt solving session. So every week kind of a live doubt solving session will be there and plus you have evaluated test series even under plus subscription as well. The rates you always know Unacademy has the most competitive rates in the market and plus you can use code CA Niket, you will get minimum 10% discount. Chalo, let's begin with the last paper, that is your May 22 exam. Let's begin with the last paper, which is May 22 exam. Now, check over here. We have a draft balance sheet of J Limited and K Limited. I'm not going into the balance sheet. J Limited, K Limited. If I just go down, J acquired 75% shares of K on 1st April by issuing its own shares in the ratio of 2 shares for every 3 shares of K. Okay, we acquired 75% of K. Let me just do one thing. Let me see the capital of K. Okay, we see capital of K 450 and one share is of 100 each. One share is of 100 each. So can I say it's 4.5? It's 4.5 lakh shares of 100 each. 450 lakh. Okay, so there are 4.5 lakh shares. Out of 4.5 lakh shares, we acquire 75%. Out of 4.5 lakh shares, we acquire 75%, 3.375 lakh shares. So we acquired 3.375 lakh shares and for every 3 shares, we are giving 2. So into 2 by 3. So can I say I have to give you 2,25,000 shares and my one share is worth 50. My one share is worth 50, 225 into 50, your PC is 102.5 lakhs. Your PC, 102.5 lakhs. I repeat. Total, there are 4.5 lakh shares in K. We acquired 75%. So 4.5 lakh into 75%, we acquired 3.375 lakh shares. Okay, for every 3 shares, I'll give 2 shares of mine. So into 2 by 3, I have to give you 2.25 lakh shares. And 2.25 lakh shares into 50 rupees, PC is 102.5 lakh rupees. Okay. Now the fair value of PP is 425 lakhs. J also agreed to pay an additional payment. Okay, we also agreed to pay some additional payment. What is the additional payment? Higher of 45 lakh or 30% of excess profit. It is 45 lakh and 30% of excess profit, higher of it. and they earned 15 lakh in last year, expect to earn another 20. They earned 15 lakh in last year, expect to earn another 20. So when I say excess 20 we are expecting, 20 ka 30% is 6. Okay, excess we are expecting 20 ka 30% is 6. Okay, 6 lakh or 45 lakh, whichever is higher. 6 lakh or 45 lakh, whichever is higher. So can I say I'm expecting to pay 45? Okay, 45 I have to pay. Minimum is 45. Minimum is 45 because whichever is higher. 45 I have to pay, and this will be due after 3 years. Tell me, this 45 I have to pay after 3 years. So can I say I should include in PC at its present value? Okay, next. Next, you also have to pay to one of the founder shareholder. Okay, founder shareholder is what? He is a shareholder of the company who is selling, and he is also employee. So whenever is a selling, basically he is basically an employee shareholder, I need to see the payment is towards employment or payment is towards as a selling shareholder. So we will make him 22 lakh provided he stays for 3 years. Now tell me, provided he stays for 3 years means the payment is in capacity as an employee. So this will be recognized as a post combination expense. Nothing will come in PC. Whatever we are paying will be recorded as an expense over the next 3 years. Next, acquiree. Acquiree has got some ESOPs. Their employees had got some ESOP. Now we are giving our ESOPs to them. So we got replaced by the new awards of J. So their ESOPs are basically converted into our ESOPs. Now nothing is given. We assume we are obliged to do so. Nothing is given. We assume it's obliged to do so as per the agreement or as per laws and regulation. So over here, we have to bifurcate pre-combination period, post-combination period. And the value of pre-combination period is included in your PC, and the post-combination period will go in your P&L. How to find out the pre-combination period? How to find out pre-combination period? What is the fair value of original award today? The fair value of original award today is 6 lakh. Into wasting period completed is 2. 2 divided by total wasting period is 5. Total wasting period will be the wasting period under original option or wasting period under revised, the new option, whichever is higher. The total wasting period under original is 5. Total wasting period under the replaced option is 4. Whichever is higher I have to take. So 6 into 2 by 5. Did you get 2.4? 6 into 2 by 5. The 2.4 is pre-combination period, which is to be included in your PC. And post-combination period will be 9 minus 2.4. Post-combination period will be 9 minus 2.4. That will be recognized as an expense over the remaining wasting period, which is 1 year. But in your PC, I have to include 2.4. Fine. Next, management of K has a lawsuit pending. Okay, management of K has a lawsuit pending. Can I say in their books it's a contingent liability? Okay, contingent liability coming upon business combination. Contingent liability coming upon business combination, I will record it as an actual liability if it is a present obligation and I am able to measure reliably. And if they give the fair value of it, means it's a present obligation, we are able to measure reliably. So management reliably measures the fair value as 7.5. So they have a contingent liability 70 lakhs. But in our book, we'll record it as an actual liability 7.5 lakh. An applicable tax rate is 30%. This is for DTA, DTL. We are required to prepare a consolidated balance sheet immediately on acquisition. 1st April 21. This is 1st April 21. Immediately. 1st April 21. Clear? Okay, now DTA, DTL. DTA, DTL, PP ka value is changing. PP's value is changing. Just check out. PP of K was 450. 450 becoming 425. 450 becoming 425. PP going down. So standalone books, it is still 500. Standalone books, it's still 500. But in CFS, we are recording 425. Asset going down, it's a loss. But it will be allowed as deduction later. Asset going down, it's a loss, but it will be allowed as deduction later. What do I do? What do I do? Asset going down, loss, it will be allowed later. I have to create a DTA. Yeah, DTA to be created. And one, we have recorded some contingent liabilities actual. So in standalone books, it's still contingent. In CFS, it's actual. So we recorded 7.5 liability. When I record a liability, it's a loss. But it will be allowed as deduction later when we actually pay them. So again, liability booked is a loss which will be allowed as deduction later. Something allowed as deduction later, create a DTA. So I have to create DTA on this 75 and I have to create DTA on this 7.5. 82.5 into 30%, 24.75 is your DTA. So 75 and 7.5, 82.5 into 30% is 24.75 DTA. Okay, before I go for consolidated balance sheet, I need goodwill capital reserve. Yeah, goodwill capital reserve चाहिए. For that, first I need PC. PC में check out PC. Check out the PC. I already told you, one, we are giving shares. They had 4,50,000 shares. We acquire 75%, 337,500. For every 3 shares, we are giving 2. So I have to give mine. I have to give mine 337,500 into 2 by 3. 225, 225 and 1 share is at 50 rupee, 112.5. Plus, there's a deferred consideration. What's the deferred consideration? 45 rupee I have to pay after 3 years. The deferred consideration 45 after 3 years, the present value. And third one, the pre-combination period value of share-based payment award which is exchanged. Usme there is 2.4 rupee. The pre-combination period. This is your PC. This is your PC. 148.71 is your PC. Now take the net assets taken over. Now find out basically the assets and liabilities coming in. They have to be taken at fair value. Now the only change in fair value is in PP. And second one, we are having one contingent liability which we recorded as actual liability. Here are 7.5. All other things are book value. All other things, they are all book value. And due to change in assets and liabilities taken over, 75 asset is going down, loss, plus 7.5 liability going up is a loss. Both the loss into 30% was DTA, 24.75 is DTA. So DTA arising due to change in fair value is 24.75. Your net assets taken over comes 602.25. Did you understood? Net assets taken over is 602.25. Now NCI is 25%. It's at proportionate net asset. Question silent. We have taken as proportionate net asset. This is NCI. Now let's find goodwill capital reserve. We have PC, consideration by acquirer, add NCI minus 602.25. So you'll get goodwill or capital reserve. There's a capital reserve coming 302.98. Did you understood? Now consolidated balance sheet is pretty simple. How do we have a consolidated balance sheet? All the figures of J Limited, their assets, liabilities, reserves, everything remains same. All figures of J will remain same. K, the assets and liabilities of K is coming at acquisition date fair values. Assets and liabilities of K is coming at acquisition date fair values, which is there. And we have a capital reserve coming 302.98. Your reserves only of which company? J. J is taking over K. Everything of J remains same. KK assets and liabilities are coming and we have paid something. So 2 equity shares we have issued, 2 deferred consideration payable is there. The 2 SBPR that exchanged for pre-combination period, 2 SBPR, that all will come. And there will be a capital reserve 302.98. Any doubts? Ditto same question there in your material. Next is 1B. Let's come back. Okay, 1B. Check out. Company has entered into a loan agreement with bank. It's repayable in 6 annual installments from 26. Okay, loan taken in 21. Hence it's repayable after 5 years. 5 years ke baad. So today it is as such non-current. But there's a loan condition. Covenant means condition. What's the condition? That they are required to have an equivalent amount contributed by promoter by 4th March 22. So 4th March 22, promoters have to contribute equal amount. If promoter contribution doesn't come up, loan ka condition violated, loan becomes repayable on demand. Now if loan becomes repayable on demand, it's a current liability. So as such, loan is after 5 years. But if the term may default happen, it becomes repayable on demand, it becomes a current liability. 4th March, we could not get promoter's contribution. 5th March, we go to bank. Can I say we go to bank after the bridge? We go to bank after the bridge. So it's already repayable on demand. Bank gave extension up to 30th June. Okay, so already bridge has happened. It's repayable on demand. Now they told us extension till 30th June. But can I say extension is only for 3 months? Extension is only for 3 months. So they will not call for 3 months. But 3 months ke baad they can call. 3 months ke baad they can call. So now the liability will be shown as current liability. The question, how do we show it? It is current. Now suppose we had to get a promoter's contribution by 4th March. Okay? In January only we approach bank. Before default. When did we approach bank? January. Can I say before default? Before default we approached bank and bank told us you can get promoter's contribution by 30th June. So can I say before default only we went, and now whether default is there or not, it will be known on 30th June only. Because before default we went and the deadline 4th March is extended to 30th June. First case we went after default. Second case is we are going before default only. The default has not happened only. Now whether default is there or not will be known in 30th June. So as at 31st March there is no default. And as at 31st March there is no default, it is not repayable on demand. It will be treated as non-current. Did you understood? So case 1 is current, case 2 is non-current. Next one, question number 2. Yeah, keep smiling, man. Okay, question number 2. Company has a net worth 450 crores. Again, it's a corporate social responsibility. Net worth 500 crores is the limit. Okay, now this year is 21-22. The previous year is 21. I have to see previous year figure. Previous year profit is 7.75, more than 5 CR. More than 5 CR? Okay, the question. Whether they are required to form a CSR committee. Yes. Now they say that 0.5 paisa per unit sold will be contributed to Save Water Foundation. Out of whatever sold, 0.5 paisa will be contributed to Save Water Foundation, but only 50% has been actually paid to the foundation. Okay, should I consider CSR as only 50% or full? They say 0.5 will be contributed, 50 paisa is actually contributed. Now, if they show remaining 50 paisa is liability, to chalega. If they show remaining 50 paisa is liability, then I can consider full amount as CSR only. Okay, fine. Okay, now whether PK has an obligation to form CSR committee. Whether PK has an obligation to form the CSR committee, that's the first question. Okay, so now first of all, if I see the last year profit is exceeded, you think you need a CSR committee. But they've also given one more thing. As such, you feel you got a CSR committee, but the amount to be spent on CSR. If amount to be spent on CSR is less than 50 lakh rupee, then you don't need a CSR committee. That work can be done by BOD. Now, amount to be spent is, can I say 2% of average net profit of last 3 years? 7.75 plus 4.25 plus 4, 16 ka 2%. 7.75 plus 4.25 plus 4. 7.75 plus 4.25 plus 4 divided by 3. Average. Uska how many percentage? 2%. Divided by 3, uska 2%. Are you getting 10.67 lakh? 10.67 lakh. Yeah, so CSR committee not required. So as such, previous year limit exceeded, you feel CSR committee chahiye. But the total amount to be spent on CSR does not exceed 50 lakh. The amount to be spent, average net profit of last 3 years, is ka 2%. It doesn't exceed 50 lakh rupees. We don't need a CSR committee. Work can be done by BOD. Okay, so this is over. Now, whether 150, whether 1,50,000, kaise hai 1,50,000? Oh, will contribute to Save Trees Foundation wala thing. So whether that can be treated as a CSR expenditure, we have actually paid 50%. If for remaining 50% you showed a liability, then yes. If for remaining 50% you showed a liability, then yes. Check the solution. Net profit criteria satisfied, you feel you need a CSR committee. However, the amount to be spent on CSR is less than 50 lakhs. CSR committee will not be applicable. Current case made is only 10.66 lakhs. So you don't need to form a CSR committee. Okay, your obligation to spend 150. 150 will qualify as CSR. 50 is paid. For balance 50%, they have to make provision in books. I have provision for balance 50% not done, then it does not qualify. For balance 50%, they have to make a provision in books. Are you clear? Coming back, second one, Anandam Limited, stay in Anand, enters into a contract with customer on 1st April 19. Okay, you enter into a contract with customer 1st April 19 for sale of machine and spare part. And manufacturing time is 3 years. Okay. On completion of manufacturing, Anandam Limited demonstrates machine and spare part meets the agreed specification. 31st March 2, customer pays for machine and spare part. Can I say customer paid the money? But takes the delivery only of machine. He takes the delivery only of machine and he requests that spare part be stored at your warehouse because your warehouse is nearer to their factory. Your warehouse is nearer to their factory. So they are telling, sir, I'm taking machine right now. Store spare parts, you keep it. You keep it. I'll take whenever I need. They have paid money. They have paid money for both. But they took delivery of machine, spare part, they say we'll take later. And we expect to hold the spare part for 1 to 3 years. I feel they will ask for spare part after 1 to 3 years. TK, how to record revenue? Okay, machine delivery is given. Machine, the delivery is given. I can record revenue. But spare part delivery not given. Delivery not given. Okay, you know bill and hold concept. Bill and hold concept. So based on bill and hold concept, I can record revenue, but the criteria for bill and hold should be satisfied. Now see, when you're writing answer, the theory becomes important. As per bill and hold concept, the reason for bill and hold must be substantive. You billed it, but delivery is basically not taken. The buyer's request. वो substantive हो गया. Number 2, the goods should be kept ready. It should be kept ready for dispatch. Whenever they want, I can dispatch it. Second, it should be separated and should not be used for any other purposes. So I cannot use for any other purpose. They are ready for dispatch anytime it is required. And the reason for bill and hold is substantive. All that criteria are satisfied. Then in that case, you can record revenue. Check over here. Anandam stores the spare part in separate section. They are ready for immediate shipment and does not have authority to use them for other customers. So can I say criteria for bill and hold are satisfied? Okay, so based on that, we can record revenue for spare part also. But now I tell you, there's a third performance obligation also. What is the third performance obligation? I have to store spare part for 1 to 3 years. If I have to store spare part for 1 to 3 years, so can I say I'm giving you a kind of renting services, space. That should be booked as revenue over that 1 to 3 years. So check the solution. Sale of machine, you can record immediately. Spare part, bill and hold if all criteria are satisfied. Now, if you don't write theory, marks will not be there. The reason must be substantive, product must be identified separately, it should be ready for physical transfer and you cannot use it at any other place. Here all conditions are met, you can record revenue. Custodian services, you have to store for 1 to 3 years. That services should be for a period 1 to 3 years. You record on straight line over a period of time. Clear? Next one, C point. Next one, C point. Card Limited is engaged in business of manufacturing car locks and nut bolts. Car locks, nut bolts. Okay, car lock. Price is 150, selling price 1800. Any unused car lock can be returned and I'll give a refund, full refund. 30 days may if you return it, I'll give a full refund. Fine. You sold 20,000 locks. So as such, 20,000 into 1800, total 3 crore 60 lakhs comes. But I feel 4% will come back. If 4% I'm expecting a return, I should not record 360. I should record 96% of it. Yeah, even though I received 3 crore 60 lakh, I'll not record revenue 360 because 4% I'm expecting return. If you're expecting return, you show that much as a liability. And now, if you are not showing that as a sales, stock with customer will come up, but stock will come up at cost. Okay, I'll not record revenue for full 20,000. I'll record revenue for 96%. ये 20,000 का revenue record नहीं करूँगा, 96%. तो can I say I'll record a revenue of 19,200 units. For 800 units, I'll book a liability. Money is received, but I will have to pay it back. So that's one. And for that 800 units, I'll show stock with customer. Next is nutballs. Nutball, we have a 1-year contract with a customer. 1-year contract. And the price will be based on volume. If they have this much volume, 1 to 50,000, the price is 200. If they have 50,001 to 1 lakh, price is 190. 1 lakh 1 to above, so it is 180. So can I say there's a variable consideration? Price may be this or this or this. So which one to take? Which one to take? Depends on your estimate. It depends on expected revenue, what you are expecting. So you estimate the sales volume will be 90,000. Okay, can I say it falls here? 90,000. I should book a revenue at 190. Day one they placed order for 24,000 pieces. Day one they placed order for 24,000. They paid 200. Even though they placed order for 24,000, they paid 200. I know cumulatively in a year, I'm expecting is 90,000 unit. The price will be only 190. So don't record 200 as a sales. So you received 24,000 into 200. You received 24,000 into 200, 48 lakhs. Don't record revenue 48 lakh. You have to record 24,000 into 190, 4560. An extra 240, 24,000 into 10. That you show it as a liability. Okay, the check over here, the solution. Check over here, solution. For the first case, significant reversal should not happen. I feel 4% return will come. So see, 19,200 pe we have booked the sales. 19,200 pe the sales is booked. Okay, the revenue is 19,200 pe. For 800 units which we feel will come back, we have to show a liability. And for that 800 units we are showing liability now. We have not booked sales. So that 800 units of ours lying with customer, that you show it as an asset with customer. 800 into 1500 is 12 lakh. That is stock with customer. Okay, for the second one, the transaction price is 190. Transaction price is 190. So we'll record a sales of 24,000 into 190. An extra 10 rupee, 24,000 into 10 is a liability which is recorded. Are you clear? Next, question number 3. Next is question number 3. Okay, question number 3. This is on Ind AS 19, employee benefits. Fair value of plan asset is 20,40,000. Present value of defined benefit obligation is 2125. Beginning में plan asset this, liability this. Now, during the year, you received a contribution 475. You received a contribution 475. You made some additional investment. That's contribution. It's added to plan asset. Okay, benefits paid is 265. Benefits paid, we sold investment and we paid liability. Okay, we sold investment, the asset goes down. We paid liability, liability goes down. We sold investment, asset goes down. We paid liability, liability goes down. Current service cost, liability increases. 5% interest on plan asset and liability. So opening asset and liability. On asset, 5% interest income. On liability, 5% interest expense. Okay, so due to interest income, asset increases. Due to interest income, asset increases. Due to interest expense, liability increases. ठीक है. Fair value of plan asset closing and the present value of obligation closing. So in your asset, your opening asset plus additional investment is given. Okay, you sold off some investment, that is given. Interest income is given and closing is given. The balancing is return on plan asset other than interest income. What is the balancing? Return on plan asset other than interest income. ठीक है. Liability में opening liability given, opening is given, current service cost is given, interest is given, that all is added. Okay, we paid off some liability deduct. Closing is given. The difference is actuarial gain loss coming over there. So if I go to solution, opening उसके interest, यहाँ पे opening उसका interest. Okay, contribution received, added to asset. We paid something. So we sold investment, asset goes down. We paid liability, liability goes down. We sold investment and we paid. Closing was given. The यहाँ पे balancing is return on plan asset other than interest. And here the balancing is actuarial gain loss. Now question is, what will come in balance sheet? What will come in P&L? What will come in OCI? Balance sheet में this closing balance. Balance sheet में the closing balance. Done? Now, what will come in your OCI? OCI में return on plan asset other than interest and this actuarial gain loss. The two balancing figures will come in OCI. And what will come in P&L? What will come in P&L? This interest, both the interest will come in P&L. Current service cost will come in P&L. Interest will come and current service cost will come. Additional investment done or investment sold, liability paid, that doesn't come in P&L. So P&L mein these three things will come. Both the interest and current service cost. This two will come in OCI and last two will come in your balance sheet. Are you clear? Are you clear? Thank you. Next, Zera Limited. Zera Limited obtained a term loan 1080 lakh for renovation of factory. For renovation of factory 1080 ek loan. Now 1st April 21 we took. Machine was acquired, modernization scheme installation was completed 30th April 22. Okay, we took loan in 1st April 21. It got completed on 30th April 22. Can I say after 13 months? The loan was taken for something, 13 months के बाद it's getting completed. That's a qualifying asset. ठीक है. 910 was incurred on installation of plant and machinery. Balance used for working capital. Oh. So out of 1080, only 910 used for this purpose. That's a qualifying asset. Working capital is not a qualifying asset. Management considers 12 months as substantial time. Management considers 12 months as substantial time. And for being a qualifying asset, they paid a total interest 94.4. Can I say 94.4 is on 1080? On 1080, 94.4. We can capitalize only on 910. Okay, so 1080 pe we paid 94.4. So on 810 it will be how much? 910. On 910 it will be how much? So 910 into 94.4 divided by 1080. This is 79.54. This will be capitalized. Balance will go in P&L because it was used for working capital. Now, would your answer be different? Would your answer be different if the modernization got completed in December 21? We started in April. It got completed in December. So can I say 9 months mein? And management considers 12 months to be substantial period. If management considers 12 months to be substantial period, we complete in 9 months, it's not a substantial period. So again, it's not a qualifying asset, nothing to be capitalized. Okay, the check solution. First wale case 79.54 is capitalized, balance goes in P&L. Second wala case, when construction was completed in December only, it is less than 12 months, not a qualifying asset as per the management's call. They say 12 months. Okay, the whole interest will go to P&L. Did you understand? Okay, next one. Next one, C point important. It's Ind AS 21. Ind AS 21. Okay, you acquire 75% in V Limited. G Limited acquires 75% in V, which is in USA. Okay, so I acquire 75% of company which is in USA. Now question, whether goodwill should be found out in dollars or goodwill should be found out in rupee? They are in USA. Goodwill should be found out in dollars or goodwill should be found out in rupee? Okay, goodwill has to be found out in, Ashwath, dollars. Goodwill has to be found out in dollars. Very important. Whenever you acquire a foreign subsidiary, find out goodwill in dollars. And that goodwill is treated as a part of asset of that foreign operation. That goodwill is treated as a part of asset of that foreign operation. And remember that assets liabilities of foreign operations are converted at closing rate in CFS. And then every year end, the goodwill figure will change because the closing rate changes. If you acquire a foreign subsidiary, goodwill you find out in terms of foreign currency. In your CFS, goodwill will be at a closing rate. Every year closing rate changes, goodwill figure will change. Okay, the check over here. 30th September, when you acquired, the net asset is 10 million, PC is 7.8 million. Okay, so we'll find out first of all goodwill in terms of dollars. Okay, 30th September rate is this, March rate is this, and then they'll be converted at a closing rate, March rate. So check out the solution. Identifiable asset USD में. To bank to NCI, difference goodwill is in USD. On reporting date, it will be the closing rate, the goodwill will come up. So यहाँ पे whenever you acquire a foreign subsidiary, goodwill every year will keep on changing based on closing rate changes. Are you clear, Ashwath? Goodwill is regarded as part of asset of that foreign operation, and उनके assets liabilities, they are converted at the end at closing rate. Now there's one more question over there. Okay, the V Limited sold goods costing 1.9 million at 3.1 million to GEM. Okay, subsidiary sold to parent. Can I say we purchased some goods? Okay, when I purchase a goods, I'll record. It's a foreign currency transaction. I'll record purchase at the rate prevalent on the date of transaction. I'll record purchase at 70.5. So 3.1 into 70.5. 3.1 into 70.5. That will be the purchase recorded in my books. And creditors are brought to closing rate, not purchases. The creditors are brought to closing rate, not the purchases. The inventory is 218.5. Inventory is with me only. Inventory doesn't go to closing rate. Creditor goes to closing rate. Yes, no? Inventory doesn't go to closing rate. What goes to closing rate? Creditors. Inventory is with me. If it was there, if it was with subsidiary, I told you subsidiary ke paas it will come at closing rate, but ICI was not taking mistake, I told you. Remember July 21 paper? Okay. But यहाँ पे inventory is with me only. So it will appear at the same rate 70.5. Okay. Now how much is unrealized profit? Can I say 1.9 million? This one for 3.1. So 1.9 minus 3.1. It's 1.2 million is profit. 1.2 into 70.5. 1.2 into 70.5. So 84.6 is coming. But only 50% of goods are unsold. 50% are there with me. So unrealized profit is also 50%. 50% are there with me. The unrealized profit is also 50%. So 1.2 million into 70.5 divided by 2. Is it coming 42.3? 42.3. That's the answer. Check out over here. Unrealized profit 42.3 million rupees. So 1.2 million pay, 70.5, it's with us only, it is there at that rate only. So that's the total profit, half is unrealized, half becomes 42.3. Next is question number 4. Next is question number 4. Okay, X Limited issues 1.5 crore convertible bond. ठीक है, 1st April 8 years. You offer interest 5.5%. Each bond can be converted at any time in next 8 years. Each bond can be converted at any time in next 8 years. If you don't convert after 8 years, you get cash. If you don't convert after 8 years, you get cash. So it can be converted. Option है, optionally convertible. Okay, the optionally convertible bonds which are issued, can I say they are a compound financial instrument? I need to find out liability component, equity component. Okay, how to find liability component? Whatever we have to pay. Can I say we are paying 5.5% interest? So 1.5 crores into 5.5%. 1.5 crores into 5.5%. So we are paying every year 8,25,000 interest. 825, 825, 825, 825, 825, 825, 825. Last may I'll also pay 1.5 crore. So whatever I am paying, discount it by a normal rate without conversion option. So whatever we have to pay, discount it by 7%. What you get, that's a liability component. Balance becomes equity component. So give journal entries. Calculate interest expense for all 8 years and give accounting entries if holder elects to convert at the end of 4th year. Fine. Okay, first of all, let's find out liability day 1. Let's find out liability day 1. Whatever we have to pay. Whatever we have to pay. कहाँ गया ये रहा. Whatever we have to pay ये रहा. We have to pay principal at the end of 8th year. उसका present value at 7%. And interest we have to pay every year 8,25,000. Uska present value. Total present value 1 crore 36 lakhs. Can I say we got 150? Remaining is equity component. The equity component is 1343. Equity component 1343 and liability is 136. Now on 136 interest accrues at 7%. We paid 825. Again accrues 7%, we paid 825 to check out this amortization schedule. So this is 136, interest accrues 955, we paid 825, closing. Again interest accrues 965, we paid 825, closing. And that way it becomes 150 at the end. Okay? Now there's one more question. What is that one more question? Give journal entries if they elect to go for bond at the end of 4th year. So I assume till 4th year everything was fine. Okay, 4th year end. This is 1st year, 2nd year, 3rd year, 4th year. 4th year end liability is 142. 4th year end liability is 142 and yeah, there is a equity component. How much rupees was equity component? 13 lakhs. If they go for shares at end of 4th year, liability, equity both gets converted into equity share capital. Liability goes away, equity goes away, both gets converted into equity share capital. To check, your liability goes away 142, equity goes away 13, everything gets converted into equity share capital. Did you understood? Clear? Okay, next one, B. Discuss the following in conceptual framework for financial reporting. Cost constraint. Now, whenever we prepare financial statement, can I say preparation of financial statement involves some cost? Free में तो नहीं बनेंगे ना. Preparation of financial statement involves some cost. Like provision for gratuity, we need actuary certificate. Actuary will not do for free. Now, what happens is when we are preparing financials, cost is involved. Okay, if I want to make a provision for debtor, a very proper one, very proper provision for debtor, so I need to put a detective behind every debtor. Yeah, I need to put a detective behind every debtor to understand how they are really. Okay, do you think it's feasible to put a detective behind every debtor to understand the real situation so that I can make a proper provision? Sir, it will involve too much cost. So cost of preparing financials should not exceed the benefit to be generated out of it. That's basically the cost constraint. And That's a subjective matter. What cost is allowed, what cost is not allowed, what should be done, not done, it's up to you. But cost constraint is to be considered. Second, executory contract. What is the executory contract? Both the parties have not done anything, or both the parties have performed to an equal extent. Both the parties have not done anything, or both the parties have performed to an equal extent. That's called as executory contract. Now, if it's an executory contract, can I say we both have not done anything? They have to receive also, have to pay also. One asset is also there, one liability also there. As such, it's nil-nil. But, if that executory contract became unfavorable to me, I have to book a liability. If that executory contract became favorable to me, then it becomes a financial asset. So normally, this is nil-nil, one asset, one liability, as such nil-nil. But if it becomes unfavorable, we should book a liability. Onerous ho gaya, yaad hai? Onerous contract. Unavoidable cost of meeting the contract will exceed the revenue to be generated out of it. The executory contract, if it becomes unfavorable, we record a liability. If it becomes favorable, we record an asset. Okay. There's OR. What is integrated reporting definition? 5 salient features. Yaad karo, 5 salient features of integrated reporting. It's a principle based, targets private sector, but can also be used by public sector people also. Identifiable communication. What is identifiable communication? Either integrated reporting can be a separate section in annual report, or it can be a part of some already reports which are there in annual report, or it can be a separate report altogether, not a part of annual report. That's identifiable communication. It focuses on value creation. It focuses on what? Value creation. So these are all features, salient features of integrated reporting. Let's go to the solution first. This cost constraint. Reporting imposes cost, and it's important that the costs are justified by the benefit. Assessment are based on combination, so whether this much cost should be incurred or not. That assessment should be based on qualitative and quantitative information. ICAI seeks to consider cost and benefit in relation to financial reporting generally. So generally, it should not be related to some individual reporting entities. So generally, that cost is to be considered, because cost of creating financial should not exceed the benefit. Okay, executory, neither party has done anything or both has done equal thing. So the right is also there, obligation is also there. Neither party has done anything. So I have to do also, and I'll be getting something also. And the combined right and obligation constitute a single asset or liability. Net it normally becomes zero. If the terms are unfavorable, you have to book a liability. If the terms are basically favorable, you don't book an asset because it becomes a contingent asset. So unfavorable, you will be booking a liability. So whether such asset or liability is included depends on recognition criteria, measurement basis. Liability, we book it if the contract becomes onerous. Integrated reporting definition is there, 5 salient features. Which are the 5 salient feature? Principle based approach, targets private sector, identifiable communication. It includes financial, non-financial, both information, and focuses on value creation. Next is question number 5. Next, question number 5. Okay, question number 5, the first A point is important. Question number 5, the A point is important. You received 2 government grants. First, a cash grant 24 lakh towards skill development of employee over 18 months. So can I say I have to spend over 18 months? I have to spend over 18 months. So can I say that grant should be recognized as income over 18 months? Okay, starting from 1st April 2020. Okay, the 1st April 2020 is 18 months. So can I say 12 months comes in this year, 6 months goes in next year, 12 is to 6. 12 is to 6. Can I say 2 is to 1? So I should divide the grant 24 lakh into 2 by 3. Can I say 16 lakh grant in this year, 8 lakh grant in next year? Yeah, 18 months may have to divide. 18 months may have to divide. So it is basically 12 months coming in this year, 6 months in next year. So 2:1 may have to divide. It's 12 months and 6 months. So 24 lakh into 2 by 3, 16 lakh grant in this year, and next year may 8 lakh. Now the cost which you have spent is 30 and 20. 30 and 20. How this should be accounted in books? How this should be accounted in book? 1920. March 20 you got. March 20 when I got, I have to fulfill condition next 18 months. I have to fulfill condition next 18 months. I should not record any revenue now. Yeah, I have to fulfill condition next 18 months. I cannot record anything right now. So March 20 when I receive, I'll show it as liability. So check karo solution. March 20 recognized as liability. ठीक है ना? Liability में next 12 months में what will be recognized, that is current. उसके बाद what will be recognized is non-current. So 16 lakh, the next 12 months is current, balance is non-current. Now when I come to 2021, that 16 lakh will be recognized as income, 8 lakh will be liability, but that 8 is a current liability. Balance of 8 lakh reclassified as current in the liability, and balance 16 will be coming as income. So if I just try to see over here, on March 20, full 24 lakh is liability. March 21, 16 lakh income, 8 lakh is liability, and March 22, nothing is liability, full income ho gaya. So when I got full was liability day 1. Then condition is to be fulfilled next 18 months. 12 months over, I'll book income of 12 months. 6 months, 8 lakh is a liability. Okay, now this is extract of P&L. P&L mein how do we show this government grant? Two options. Either you show government grant as other income. So there's other income and then there is an expense related to it. Or you show net of expense. So one is other income. Alternative 2 is net of expense. Expense में से net हो गया. Training cost 30 minus 16. Either you show 30 expense and 16 income. 30 expense and 16 income. Or you show net expense only. 30 minus 16, 14. Did you understood? I hope you are clear. 2:1 में 12 months to be recorded next year में 6 months उसके बाद. Ashwath, clear? Okay, next one is also good. I told you this question was good. Okay, grant of 10 lakh receivable over 3 years. Okay, 10 lakh is receivable over 3 years. 5 lakh, 2 lakh, 3 lakh. 5, 2 and 3. Contingent upon developing and maintaining gardens for 3 years. Developing and maintaining garden for 3 years. Now, developing is only once. Maintaining is 3 years. Developing is once. Maintaining is 3 years. You developed in 1920, total cost 6 lakh. Maintenance cost 1920, 12, 2021, 15, 2021, 22 is 17. Okay, so now how is the cost to be incurred? How is the cost to be incurred? Pay attention. How is the cost to be incurred? So, first year 1920, development cost 6, maintenance 12. So, can I say first year mein 18 lakh is to be incurred? Second year 15, third year 17. So 18 plus 15 plus 17. Can I say total 50? Total 50. Okay, total 50 is the cost to be incurred. How it is to be incurred? 18, 15, 17. So can I say grant should be recognized as income in that ratio? 18 is to 15 is to 17. That ratio. Okay, now what is the total grant? 10 lakh. So 10 lakh into 18 by 50. 10 lakh into 18 by 50. 3.6 should be recorded in first year. 10 lakh into 15 by 50. 3 should be recorded in second year. And 10 lakh into 17 by 50. 3.4 should be recorded in third year. So first year I should record 3.6, second year I should record 3, third year I should record 3.4. So check over here the solution. First year 3.6, second year 3, third year 3.4. Did you understood this ratio? Okay, now first year grant income is 3.6, but you have received 5. First year income is 3.6, but you have received 5. The extra 1.4 will appear as a liability. Okay, till second year, I have to record income 6.6, but we have received 7. Till second year, we have to record 6.6, we have received 7.4 will be liability, deferred income. Till last year, we have to record 10, we have received 10. We have to record 10, we have received 10, nothing is liability now. Did you got it? So till first year 3.6 should have been income, but we received 5. Extra we have received 1.4, that becomes liability. Till second year 6.6 is income, but we received 7.4 is a liability. Until third year we should record income 10, we have received 10, nothing is liability. So deferred income is nothing but your liability. Are you clear? Okay, going to your B point. Okay, Black Limited is a manufacturing company. The following balances as at March 21 and 30th September 21 and March 22 are given. So we have a carrying amount March 21, 30th September 21, March 22. Attributed goodwill, then intangible, then financial asset measured at FVT OCI, then some PPE, deferred tax, current asset. Current liabilities, provision, total. Okay. Black decided to sell the business on 30th September 21. Can I say we decided to sell on this date, 30th September? We decided to sell. Now, if we decided to sell and if it meets the criteria for held for sale, if you remember criteria for held for sale, two things. It should be available for immediate sale and sale is highly probable. It's available for immediate sale and the sale is highly probable. So, this date say it becomes held for sale. Now question, last 31st March was 33,350, now it became 28,890 carrying amount. Last 31st March say till the date classified as held for sale. How to account for this difference? Last 31st March to till the date it's classified as held for sale. This is accounted as per the respective end days. Now it's classified as held for sale. Now the carrying amount is this. Now it will appear at carrying amount or fair value less cost to sale, whichever is lower. So from 33,350 to 29,890, that is accounted as per respective end days. Clear? Now 29,890 is the carrying amount. Now you propose to sell at 26,000 and estimated cost to sell is 200. So can I say now 26,000 minus 200, fair value less cost to sale is 25,800. Fair value less cost to sale. Now 29,890. 29,890 minus is 25,800. So carrying amount is 29,890. Fair value less cost to sale is 25,800. Fair value less cost to sale is 25,800. Now you book at whichever is lower. I will show 25,800. The 4,090 loss comes. So on the date of classification as held for sale. 4,090 loss is coming. How to bear that loss? First, goodwill. Out of 4,050, 2,560 goodwill. And remaining 1,530. See, FPT OCI, this cannot come, deferred tax will not come, current asset will not come. That will be this and this proportionately. The remaining 1,530 will be between Intangibles and PPE proportionately. Did you understood? If I just go down to the solution, I'll come back again to the question. Okay, the 30th September 1, fair value less cost to sale is 25,800. You have an impairment loss 4090. Goodwill goes 2560. Remaining between intangible and PPE proportionately. And now the revalued figures now 25,800. Are you clear? Now going back to the question. Now 25,800 ho gaya. Now March 22. Do one thing. The other things like ye FVTOCI 5260 now becomes 7310. 5260 becomes 7310. There's an increase as per some other standard that needs to be considered. Disposal group hai pura. Deferred tax is decreasing. Current asset is decreasing. Current liability is increasing. Non-current liability remains. This non-current liability remains same. So this effect I have to give. So let me just go down. Can I say it was 25,800? It was 25,800. Now, these are the changes as per that other standard. FVTOCI wala thing, it goes up by 2050. Deferred tax is going down by 150. Current asset is going down by 2180. Current liability is going up by 2960. Non-current liability mein same, nil. So now net your assets are going down by 3240. Net asset is going down by 3240. So now the balance 25,800 minus 3240. 25,800 minus 3240. Can I say it is coming 22,560? This changes happened due to other Ind AS. This all changes happened due to other Ind AS. So now it is 22,560. Now what is the fair value less cost to sale? Go back to the question. Now what is the fair value less cost to sell? The fair value less cost to sell has now fallen to 19738. So 22560. 22560 was the value in books. We have to make it as 19738. Can I say 2822? Is the value going down? We have to make it as 19738. So 2822 is the value going down, and that 2822, goodwill is already gone. Other assets, they were already as per some other standard. So it will be borne by intangible and PPE proportionately. And after this, now it becomes 19738. Did you got it? So first of all, from March 21 to September 21, that is all as per the respective standard. September 21, now it is classified as held for sale. We need to compare the carrying amount and fair value less cost to sale, whichever is lower. Okay, so now it became 25,800. Now the other assets are again to be measured, like inventory again will be continued as per Ind AS 2. So other assets, September to March, they are measured as per the respective Ind AS. Now the carrying amount of the disposal group is 22,560, but the fair value is 19738. So from 22,560, we have to bring it to 19738, and this loss is borne by intangibles and PPE proportionately. I hope you are clear. It's a good question. Yeah, we have a similar question in our material, so it's not like something new, but it's a good question. Come back to the question. C point. Come back to the question, C point. Okay. Gold Limited, a manufacturing company, prepares financial statement 31st March every year. They've issued 10 lakh ordinary shares. Okay, they're having some 10 lakh ordinary shares. 6% convertible bonds amounting to 1 lakh. And terms of conversion, 120 share for every rupee 100. Rupee 100, 120 shares. 30th June 21. 30th June 21. 50,000 bonds, rupees 50,000 bonds were converted. Now, for every 100 rupee, we are giving 120 share. So, for 50,000 into 120 by 100 will give 60,000 shares. For 50,000 will give 60,000 shares. Profit is 2,50,000. Compute basic and diluted EPS. Okay, first let's go to basic. Profit is given 250. Profit is given 250. Directly take that. Divided by. Okay, 10 lakh shares were already there. Okay, June 21 onwards, extra 60,000 share came. So 10 lakh were there for full year, 60,000 for 9 months. So 60,000 into 9 by 12, 45 plus 10 lakh. 10 lakh 45,000 will be the number of equity shares weighted average. If you see solution, profit is 250 given. Ordinary shares is 10 lakh and new shares we issued in June. We issued at June end. So this is for 9 months 45. So basic EPS is coming 0.239. Are you clear? Now next question is about diluted EPS. Pay attention. Pay attention. Now diluted EPS. There are few shares which are not yet converted. And there are few which are converted. Remember, out of 1 lakh nominal value, 50,000 rupees were only converted. Remaining 50,000 is still pending. Okay, if everything was converted at beginning only, what would have been the EPS? That's the diluted one. So, pehle se everything was converted. Okay, so if pehle se everything was converted, there will be addition in numerator also. There's addition in denominator also. First, coming to numerator adjustment. Profit 250. If everything was converted, can I say interest is not to be paid? Yeah, if it was converted beginning only, interest not to be paid. Now, in this 250, for unconverted share, interest of full year is there. But for the converted one, interest of only 3 months was there. In this 250, ones which are converted, can I say from June onwards, July onwards, there was no interest. So for unconverted share, full year's interest is there. But for the converted one, only 3 months interest was there. So when I'm trying to add back for unconverted share, full year interest is added. For unconverted share, full year interest, rupees 50,000. 50,000 was converted, remaining rupees 50 was not converted. Into 6%, and I have to take net of tax, so 25% is tax. And they will get converted into 60,000 shares full year. For the converted ones, can I say, यहाँ पे in shares they were already taken for 9 months. And interest में already interest for 3 months was taken. So now interest you have to add back only of 3 months, because from July onwards there was no interest only. So add back interest for only 3 months. So here for this converted ones, usme interest for 3 months is added in profit. And in number of shares only 3 months you add, because 9 months to already add ho gaya tha. If it was converted from beginning, instead of this 9, it would have been 12 months. 9 was already added, so now you add only 3 months. So 3 months interest added back, 3 months shares added back. So for unconverted 50,000 rupee, full year interest was there and full shares. For the converted ones, only 3 months interest went now. So 3 months ka interest add back karo and 3 months shares add back karo. Did you got it? Now you have this figures. Now your diluted EPS is 0.226. Are you clear, Ashwath? This is a good question. Yes, the same question is there in our material. Same question is there in our material, but it is a good question. Coming to question number 6. Coming to question number 6. Shravan Limited. Shravan Limited owns 6800 ordinary shares in PQR. ठीक है. PQR has a total share capital 2 lakh shares. And after tax maintainable profit is 28 lakh per year. Appropriate P ratio for industry is 12. Appropriate P ratio for industry is 12. इसका meaning the valuation is 12 times the earnings. जितना आप earn करते हो, you get a valuation 12 times. If you are earning 28 lakhs, the entire company will get a valuation of 28 lakh into 12. Can I say 3 crore 36 lakhs? This entire company. Divided by total 2 lakh shares. Divided by total 2 lakh shares. So can I say one share valuation is rupees 168? One share valuation is 168. But they said the management estimates the discount for lack of marketability is 18%. I'll not consider 168. 168 minus 18%. I'll not consider 168. I'll take 168 minus 18%. So can I say I'll value one share at 137.76? How many shares do I hold? I'll value them at 137.76. How many shares do I hold into 6800? The value will come 936,768. 936,768. Again, we are earning 28 lakh per year. P ratio is 12. So can I say valuation of entire company is 28 lakh into 12. This is the valuation of entire company, 3 crore 36 lakhs. They have total 2 lakh shares. So per share valuation is 168. But their question has clearly said we use a discount of 18%. So per share valuation is now 137.76 into 6800 shares we hold 936,768. Let's go to solution. Let us go to the solution. Check out here. The fair value of investment is 936,768. Next question number 6B. Okay, question number 6B. X Limited has made a borrowing from a bank 20,000 at a fixed interest of 12%. 20,000, 12% interest. Loan processing fees are paid separately, 1,000 rupee. Okay, so can I say in my book loan will not be 20, in my book loan will be 19. In my book loan will not be 20, loan will be 19. And whatever interest I am paying is on 19, so effective rate of interest will go up. Effective rate of interest will be going up. Fine. You borrowing 20,000, interest rate 12%. Loan processing fee is 1,000. And the loan is repayable in 4 half-yearly installment of 5,000 each. The loan is repayable in 4 half-yearly installment of 5,000 each. Now see, principal is 20. Principal is 20. I repay 5,000, 5,000, 5,000, 5,000. So can I say I'll be repaying is 5,000 each plus the interest. 5,000 plus interest bhi hoga. Okay, fine. Loan 20,000, start loan is 1st April, finish after 2 years. 5,000, 5,000, half yearly. Date of repayment, it starts from 30th September, then 31st March, again 30th September, again 31st March. Installment is 500, interest is 12% per annum. And see, very, very important, interest charge. Interest is to be charged and paid quarterly. So installment, principal you are paying half yearly. Principal you pay half yearly. Interest you are paying quarterly. Did you understand? Upfront fee is 1000 and your effective rate of interest is 16.6. Effective rate of interest is 16.6. Now just pay attention. If I try to understand what I'm paying, if I try to understand how much interest I'll pay, so this is the total interest which I'll pay. Okay, first year Q1 loan is 20,000. I have to pay. How much is the percentage given? 12. 20,000 into 12% into 3 by 12. 20,000 into 12% into 3 by 12. Is it coming 600? Q2 also will remain 600. But now Q3 onwards, how much loan I have repaid? Q3 onwards, how much loan I have repaid? Q2 end May, I would have repaid 5,000. Yaad hai? Half yearly I'll pay 5,000. So now it is 15,000. Did you got this? Into 12% into 3 by 12. This will come 450. Q4 also it is the same. 450. Okay, now second year Q1. Second year Q1. Can I say now loan is 10,000? I would have again paid 5,000. Into 12% into 3 by 12, interest will become 300. Q2, this is 10,000 into 12% into 3 by 12, 300. Q3, now the loan is only 5,000 because we would have again repaid 5,000. Into 12% into 3 by 12 is 150. And Q4, this is 5,000 into 12% into 3 by 12, 150. Did you understood this? Did you understood this? This are amount of interest which you are paying. This is actually interest paid. This is not interest expense. Expense will be based on effective interest rate. This is not interest expense, this is interest paid. Interest expense in P&L. Interest expense in P&L will be based on effective interest rate. These are interest paid. Okay, now if I ask you day one, can I say loan starts at 19,000? Day one, loan starts at 19 in your books. 20 tha, 1,000 is processing fee. Okay, then now just pay attention. Opening. Interest accrued. We paid something. And closing. So in Q1, opening was 19. Q1 opening was 19. How much interest accrued? It's 19,000 into कितना percentage था? Effective rate of interest 19,000 into 16.6%. 16.6%. 3154. Are you getting? Acha, not 3154 into 3 by 12. Quarter है ना? 789. Did you got 789? 19,000 into 16.6% into 3 by 12. And how much did we pay? 600. We paid 600 Q1 में. So 19 plus 789 minus 600, it becomes 19,189. Now Q2, 19,189 was pending. Interest accrues. Interest accrues 19,189 into 16.6% into 3 by 12. Is it coming 796? And now we paid 5,600. So how did we pay 5,600? Interest is 600. And remember, half yearly we are also paying principal 5. interest is 600, half yearly we are paying principal 5. So this is 19179 plus 796 minus 5600. It becomes 14385. Now Q3. 14385, interest will accrue 16.6% into 3 by 12. Is it coming 597? And we have repaid is 450 now. So quarter wise I'm going, that's it. I've repaid 450. So 14385 plus 597 minus 450 is repaid. Is it coming 14532? Now Q4, it was 14532 into 16.6% into 3 by 12. Is it coming 603? And we repaid 5450. So how do we get 5450? 450 interest, 5000 principal. So 14532 plus 603 minus 5450. Now remaining is 9685. Are you getting it? Are you getting it? Now check. I'll just go back to the solution. Okay, same thing which I have taken. Okay, these are the payments what they've shown. I just go over here. So 19 was there, interest accrued, we paid 600 closing. 19189 interest accrued, we paid 5600. So see, after 4 years we got 9685. यहाँ पे भी our solution how much कहाँ गया भाई solution आजा. We also have 9685. Did you got it? The only thing, principal is half yearly, interest is quarterly, and paid is that one. Books mein it is based on, expense will be based on effective interest rate. Okay, this was a good question, bit different. It was a simple question, no brain. Actually it was a kind of intermediate level question, but you had to read it very properly. It's actually not final level question, it's actually inter-level question, but you just have to read it very calmly. Now coming to C point. Okay, F Limited owned a land property whose future use is not determined. Tell me, land future use not determined. How do I classify? Land future use not determined, it will be classified as correct investment property. How should you classify it? Investment property. Now during June, F started constructing office building on it. There was a land use not decided, investment property assumed to be for capital appreciation. Now you start constructing office building. If you start constructing office building, can I say now it goes in CWIP for own use, na? For own use, so can I say it gets converted into PP wala thing? Okay, now presuming the construction work is in progress, how should land be classified in financials now? It should be now classified as PP. Okay, what will be the change in carrying amount? Okay, tell me, if investment property becomes PP, there is no change in carrying amount. The transfers are made at the carrying amount. There is no change in carrying amount. The transfers are made at carrying amount. Okay, whether the change in classification from investment property to PPE, is it a change in accounting policy? No, we had this question. In last exam also. So whenever that change happens from PPE to investment property or investment property to PPE, it is due to the change in your use. So it's not a change in policy, वो आपका use only has changed. So it is not a change in policy. Now, in this one, would your answer in one be different? If management were to if there were management intention to commence construction. Acha, they have not started constructing. They have not started constructing. Intention is to start constructing. Then would your answer change? Now see, you bought a land, use was undetermined. Now intention is to start construction. Intention doesn't make it PP. To be recognized as a PP, the work should have actually started. To be recognized as PP, you should have really done that work. If just intention is there to start doing the work, it doesn't make it a PP. To check the solution. Okay, first it is investment property. Okay, so now you commence construction, reclassified from investment to owner occupied. And transfers do not change the carrying amount. Is it a change in policy? Answer is no, it is not a change in policy. Fourth one, if you have not started construction, just intention hai. So see, mere intention for use does not provide evidence of change in use. So you should basically say now it is owner occupied only when there is really a change in use. The mere intention is not a evidence of change in use. Continue to be classified as investment property. So don't change it to PP, continue to be classified as investment property. And the last question is question number 6C. Last question, question 6C. Okay, 6D, not 6C, 6D. You prepare a consolidated financial statement. RST acquires 75% of DEF. Okay. There are 1 crore 20 lakh shares of DEF. You acquire 75%. Okay, 1 crore 20 lakh hai, I acquire 75%. Can I say 90 lakh shares are acquired? Okay, and what happened? You issued 2 shares for every 3 shares acquired. Okay, the 90 lakh shares are acquired. I give 2 shares for every 3. Out of 1 crore 20, I am acquiring 75%. It's 90 lakh. 90 lakh shares are acquired. I'm giving for every 3 shares. I'm giving 2. So can I say I have to give my 60 lakh shares? And my 1 share is 6.5. 60 lakh into 6.5. PC becomes 3 crore 90 lakhs. PC becomes 3 crore 90 lakhs. Okay, the total 1 crore 20 lakh shares, I'm acquiring 75%, 90 lakh. For every 3 shares, I'm giving 2, so I have to give my 60 lakh shares, and my 1 share is 6.5, PC 3 crore 90 lakh. Plus, we'll make a cash payment 7150. Plus, we'll make a cash payment 7150. Kab? June 22. Okay, we acquired in 21. I'll make 7150 after 1 more year. We will make. It's not contingent. We will. Pakka. So I have to pay 7150 cash after 1 year. So can I say I have to include in PC at its present value? Plus you may make. Acha, you may. This is contingent. यहाँ पे word may है, यहाँ पे word will. You may make a cash payment of 3 crores contingent upon revenue. And this you may make it in future in 23. Okay, first date today, the fair value of contingent consideration is 2 crore 50 lakh. Next year, the fair value became 2 crore 20 lakh. Now see, a contingent consideration we include in PC at acquisition date fair value. So 1 PC, I was giving my shares, 60 lakh shares of mine are given into 6.5. Second, 7150 I have to give at the end of next year, uska present value. And third, contingent consideration, today's fair value is 250. 250 is included in your PC. So let's have this PC. Then, the day when I took over, the carrying amount of net asset is 6 crore, but the fair value is 7. Oh, remember I take the fair value. So in our books, we get the assets and liabilities at fair value. So 7 crores, but in standalone book, it is still 6 crore. In standalone book, it is still 6 crore. We made it 7. Asset increased. Asset is increased, but we are going to pay tax later. Create a DTL. So DTL is 20%. 1 crore ka 20%, 20 lakh DTL. 1 crore ka 20%, 20 lakh DTL. So 7 crore is asset, 20 lakh is DTL. Net asset is 680. Net assets will become 680. And whatever goodwill comes up on business combination, that goodwill is not to be amortized, it's just tested for impairment every year end. And March 22, they say that there's an impairment of goodwill 12.5%. Whatever goodwill came, uska 12.5%. Compute the goodwill. Compute the goodwill under the methods permitted for initial computation of NCI. अच्छा तो NCI के लिए what were the two methods? Either at fair value or proportionate net asset. Okay, to find out goodwill if NCI is at proportionate net asset, and find out goodwill if NCI is at fair value, and then you find impairment of goodwill. Okay, first let's go to PC. Same ditto question, same figures is there in material. Okay, so first of all, I'm giving shares, that was 3,90,000, 60 lakh shares of mine are given into 6.5. Deferred consideration 7150 I'm paying after 1 year, rate is given 10%. Contingent consideration, the acquisition rate, fair value is included in PC. The PC remains same. PC remains same. Net assets 7 crore but 20 lakh is DTL to 680. 680. Now, if NCI is at proportionate net asset, 680 is 75%. If NCI is at proportionate net asset, 680 into 25%, sorry. 17,000 if they are at proportionate net asset. Okay, if they are at fair value, so out of 1 crore 20 lakh shares, we acquired 75%, 90 lakh. So can I say they hold 30 lakh shares? They hold 30 lakh shares, and share of that company is 6 rupee. Unka share is 6 rupee. So it's not 6, 5.5. Let me just check. Go back and check. Unka share kitne ka hai? Ours is 6.5. Theirs is 5.5. Okay, theirs is 5.5. So NCI people are holding 30,000 shares. 30,000 shares into 5.5 will be their valuation if they are at fair value. So NCI comes this. Okay, so we have PC, we have NCI, we have net assets on DOA, we got goodwill. Impairment is 12.5%. This was the question. We have goodwill and we have impairment 12.5%. This was your question. And I tell you one thing, all questions were there from material, that's one. But if you just check out, ab just check karna, all questions which were asked, they are the questions which are marked as important in our material. So सारे question material में से थे, but सारे question are those which are marked as important. The only which were marked as important, they are only more focused in examination. You can understand you need to focus more on the questions which are marked as important. So this was your paper discussion for FR. We discussed 3 papers. Yeah, we discussed 3 papers, July 21, December 21, May 22. November 22 I'll discuss later because I want you to show how ICAI writes answer as well. So November 22 also I'll discuss, don't worry about it. Tomorrow we have a MTP discussion. Yeah, tomorrow we are having a MTP discussion for FR. November 22, Series 1, Series 2. November 21, Series 1 and Series 2. Sunday we have MTP discussion for auditing. November 22, Series 1, Series 2. And Monday evening, similarly like today, we have a paper discussion for auditing. So this week is paper discussion, MTP discussion. Any doubts? Anybody? Yes, Ashwath, for audit also we have it on Monday. So audit MTP is on Sunday, audit paper discussion is on Monday. Okay, and if you enjoyed this session, please share it with all your friends. Recommend them also to watch these sessions, and yes, do recommend them to take our lectures as well. The FR latest batch is already launched. It's a subject-wise subscription now available and at a very comfortable rate compared to market. So Unacademy always comes out with the best competitive rates. Use code CA Niket, still you will get extra 10% discounted minimum on that. And just one sentence for you, just one sentence for you. If you do not take the pain of hard work today, be ready to take the pain of regret tomorrow. Yeah, if you do not take the pain of hard work today, be ready to take the pain of regret tomorrow. See, hard work is painful. And I know today to sit for this many hours, study, do articleship, all that is all painful. But if you're not taking that pain and you're not studying, you're failing, later on I tell you, you have to slog for next 40 years in your life. If at all you become chartered accountant, or if at all you basically give your efforts and achieve something, your later life becomes convenient. But if you're not doing right now, later life becomes a slog. And I tell you, once you fail, that failure ka regret is much more than hard work ka basically the thing today. If I do hard work today it's painful, but at the end of the day, I wanted to do something, I did it, I feel happy. That gives me happiness instantly. But the day when I fail, that regret will last for a longer time. To take the pain of hard work, not the pain of regret later on. Chalo, see you all tomorrow for that MTP session. Till then, bye-bye, take care and study well.